In this week's video, we'll demonstrate why ETF leadership says a lot about stock market risk and reward. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll be taking a look at the big picture this week. Why did stocks rally off the Brexit low? Does ETF leadership favor growth or defensive assets? The answer might surprise you. How does the CCM market model adjust for long-term trading range and mixed leadership? Cover some examples of growth-oriented ETFs and hybrid/defensive ETFs. And in the end, we'll look at the story that's being told by the hard data and the charts. Let's start with the most pressing question this week. Why did stocks rebound so sharply off of Monday's Brexit low? Obviously, markets move based on an almost infinite number of reasons, but one of the big reasons was changing expectations relative to future Fed policy. Remember back in January, early January, the Fed was talking about raising rates 4 times in calendar year 2016. In terms of the market's expectations, when things were not going well, the market actually flipped over and said the Fed might actually cut rates in 2016. As we've noted in these videos before, there are a lot of important things that we need to monitor when we manage risk and reward. There is nothing more important, especially within the context of an economic expansion, than central bank policy. This week's video is more of a stack rank, hard data, and big picture story video. Let's simplify things a little bit from a bullish perspective. What's the bullish case off of this Brexit low? Well, central banks have continued to print, buy assets via QE, and basically prop up asset markets. When the market starts to adjust its expectations for Fed policy, many major money managers will say, well, the Fed's going to be easy, and it doesn't look like the U.S. economy is on the cusp of a recession. Therefore, that should be, for the most part, bullish for risk-oriented assets. From a bearish perspective, as we've discussed in the past, central bank policy tends to be more effective when the economy is in decent shape, especially at this stage of the cycle. Once the data starts to deteriorate, the central banks will have a much more difficult time, and we'll talk a little bit more about that in a few slides. Obviously, we just discussed if Brexit starts to get messy again, that could be bad for risk assets. Any type of EU contagion talk, and that means another country talking about holding a referendum or other countries starting to have rumblings about just leaving the EU. That would not be good for risk assets. Valuations are extended. So these are the major points, and obviously we could go on and on, the election, etc. But these are the major bullet points the market will be focusing on over the next few weeks. This narrative, in terms of the past few sessions, still holds. As long as it holds, then risk assets and things that are scoring well in the ETF scoring system may hold up better than expected. Once we start to check some of these boxes, the riskier the ETF, the higher the probability it's going to run into problems. Let's expand on some of these concepts within the context of the last 4 trading sessions, meaning the rally off of the Brexit low. Central banks. Title from Bloomberg.com and Bloomberg Markets, post-Brexit. ECB, which is the European Central Bank, which is Europe's Fed basically, said to weigh looser QE rules. If QE isn't loose enough, QE is basically, for the most part, using money or printing money and buying assets. And if you really get down to brass tacks, you're buying assets to prop them up. A tweet from Friday's session over the past week probability of a rate cut in England by the end of August has gone from 0 to 80%. That's a major swing in expectations for what the market was thinking the Bank of England would be doing over the next few months. One of the reasons for the sharp reversal in European stocks. Similar situation here from Twitter, June 29th. The market is pricing in a non-trivial probability of a Fed rate cut in the coming months. Another significant shift in expectations relative to global central bank policy. We just covered this bullet point in terms of the past few days. Let's go over the U.S. economy avoids recession. Regardless of what happens in the next 6 to 9 months, 18 months, right now, the economic data in the U.S. is not screaming a recession is going to start tomorrow. Anecdotal piece of evidence. Friday, ISM manufacturing consensus range was to come in between 50 and 53. It came in above expectations, and you can see the trend is improving here, which is one of the big reasons why when market expectations shift on the central bank front, markets respond. One of the reasons why markets are responding so quickly, and one of the reasons why the markets have such low expectations in terms of the Fed trying to raise rates, the markets know that the Fed is in a very difficult situation. This is interest rates, 1981, where my cursor is. This is 2009, and this is interest rates between 2009 and the present day. Obviously, this is a very odd-looking portion of this chart here. I'm guessing if you were a central banker and you saw asset prices falling like a stone from roughly January 1st to February 11th, and then you looked at a chart like this and realized you had kept interest rates at 0 and hadn't reloaded your chamber, it's probably very difficult to sleep at night. And that period is not going to be forgotten in the central bank community. Remember, when we go into a recession, the central bankers will start to lose a lot of power. For example, the shaded regions here are periods of U.S. recessions. Here's a recession during the dot-com bust. Notice, during the recession and when stocks are tanking between 2000 and 2002, the economy is not doing well. The Fed is ultra-friendly and ultra-dovish. They're actually lowering interest rates. When the economy is not doing well, it doesn't necessarily stem market declines, nor does it necessarily prop up asset prices. Same situation here. You get to a point where the market says the Fed can only do so much, and the state of the economy, valuations, the outlook for earnings starts to take precedence over Fed policy. The Fed cannot always bail out the markets. They're lowering rates here, 2008, 2009 here, during this period of very, very friendly Fed policy. The stock market tanked. Therefore, keep in mind, the typical response from central bankers during a recession is to lower interest rates. Typical response, lower interest rates. That is going to be very, very difficult to do when you basically have kept rates at 0 since 2009. The markets know that central bankers are terrified of a deflationary spiral getting underway. This post, you can Google this title, Navigating During a Period of Extreme Central Bank Intervention, has a subheading, Why Central Banks Are So Concerned About Keeping Asset Prices Elevated. They have no ammunition. They saw what happened early in calendar year 2016. Therefore, they most likely are going to try to prevent that from happening again, because if it does, it's going to be very, very difficult to stop. Once economic data turns in the U.S., it's going to be nearly impossible to stop. But we're not there yet. We're still checking this box here. Therefore, the central banks still have a lot of power in the market's eyes. The market also understands that they have limitations. Now let's flip over to ETF and market leadership and ask the question, what can we learn about the market's reaction to all of these bullet points, and how confident the market that the Fed and global central bankers can continue to keep things propped up and/or create long-term and sustainable prosperity. These are some results from the ETF scoring system, which is part of the CCM market model. We'll use some results from April of this year to illustrate concepts. The results today look similar, but they have changed somewhat. Point of the exercise, the blue here, ETFs shaded in light blue, fit into one of two categories. We either classify them as hybrid or defensive growth. These are not all hybrids. Some of these we would consider to be defensive growth. The difference is a hybrid ETF has a chance to make money and hold up in a bear market, meaning it's done it before from a historical perspective. And a hybrid can also make money in a bull market. So for example, if you're using SH to short the S&P 500, that's not a hybrid, because we know with 100% certainty that SH is going to get killed in a bull market. Hybrids give us a chance to make money in bull and bear markets. Notice I said a chance. We don't add hybrids to the portfolio based on historical profiles. We know the historical profiles, and they also have to pass screens in the present day. This list over here from earlier in 2016 is also ETFs that are leading year to date. The takeaway, this is a very odd mix of ETFs, especially when we consider that risk assets have rallied since the February 11th low. Typically, when you see a rally for several months, you are not going to have things like a TLT or an XLU on your leadership list. And what that's telling us is the market understands that the Fed is propping up asset prices and that sooner or later they're probably going to run into trouble. We also have a mixed list. Some of these ETFs are economically sensitive, and they tend to favor a stronger economy, and they tend to favor the Fed being able to create lasting prosperity. So these ETFs in here, if you're buying them, you're somewhat making a bet on two things: that the Fed can either create positive inflation or the Fed can create a stronger economy. If you're buying these ETFs, you're probably skeptical about the Fed being able to create lasting prosperity, and you may also be skeptical about the Fed's ability to create positive inflation. The stock market remains in this long-term trading range. This is Friday, July 1st here. Here's a high, here's a low. We're going all the way back on this chart to 2014. Given the stock market really hasn't been able to make up its mind in terms of breaking out to the upside or breaking down to the downside, how does the model decide which groups of ETFs we should be looking at? Should we be looking at economically sensitive ETFs and favoring those ETFs, or should we be favoring either hybrid assets or defensive growth ETFs? We've touched on this question. Let's cover it now. Why are hybrid ETFs and defensive ETFs leading after a multiple month rally in stocks? Well, obviously there's numerous reasons. One of the major reasons is market participants know that the Fed has propped up equity and asset values. Even the Fed recently, June 21st, in a report warned forward price to earnings ratios, or PE ratios, for equities have increased to a level well above their median of the past 3 decades. This is the Fed warning that stocks are very highly priced and basically overvalued by historical norms. Hence, Markets understand and respect that the central banks are going to do everything they can to avoid a deflationary spiral, but they also respect that valuations are high and the Fed has very few traditional bullets left in their recession-fighting chamber. Therefore, the answer to this question is relatively logical. The fact that hybrids and defensive ETFs are showing up on leadership lists and in screens tells us there's a lot of skepticism about how this is going to end. If you own these ETFs in green and the US economy goes into a recession and we flip over to a bear market, the probability is high that you will lose money. These ETFs in blue can do one of two things. Defensive ETFs tend to lose less in the early stages of a bear market. It depends what type of bear market. Not every bear market's exactly the same. For example, utilities may hold up in the first half of a bear market and then may be sold off at the end when everybody throws in the towel. Hybrids are different. Hybrids sometimes buck the trend for the entire bear market. A good example would be gold. Gold has had long-term bull runs within the context of a bear market in equities, and gold has been in a bullish stance and made a lot of money within the context of a bull market for equities. That's the difference between defensive growth and hybrid. The blue is both. It includes both categories. It doesn't differentiate between the two. So the trade-offs with these ETFs. If the S&P 500 goes into a bear market, you're much better off holding things that are shaded in blue for the most part. Where's the downside here? Many of these things in blue are working now. The downside would be that if the Fed can create long-term sustainable growth and the U.S. economy picks up, the downside is many of these ETFs will probably start to underperform these ones in green. Therefore, how does the model differentiate between the two, and how would it know that it would prefer to switch from blue to green or from green to blue, especially when you have this mixed bag here after a multiple month rally, which is extremely rare. The reason why we're seeing this, for the most part, two words: central banks. Some of you watching may have had a keen eye and noticed that XLB in previous versions of this slide was blue. XLB materials obviously should be green. So we're going to use XLB as the poster child for your growth-oriented weak dollar or inflation-friendly type ETFs. Think strong economy and growth, or inflation or reflation, and we'll use TLT as the poster child for your hybrid and or defensive growth type ETFs. Obviously, TLT is a hybrid. TLT can make money in bull markets, and TLT can make a lot of money in bear markets. One of the ways that the model differentiates when we have these mixed profiles is to study these ETFs in isolation, and maybe more importantly, compare them head to head. So let's look at XLB in the context of the Brexit fall and bounce. Here's the bounce here. If you know the markets well, you know the S&P 500 almost retraced all of this Brexit fall. Not the case for materials. They retraced only a portion of the Brexit loss, and they have stalled at an area that has acted as resistance in the past. Let's compare that to the price performance of TLT over the same period. XLB, as of Friday afternoon, July 1st, is down here, nowhere near printing a new high. TLT, on the same day in the afternoon, after Brexit, you would think after stocks rallied sharply for 4 sessions that TLT would have been killed this week. Not the case. TLT has printed a new closing high, something XLB was unable to do. It's much more clear if we compare the two head-to-head, which is exactly what the model does. We've covered this before. Think of Brexit again. This is the Brexit fall, the Brexit retracement in here. This is Friday afternoon, July 1st. This chart clearly favors TLT. This is a downward sloping trend channel. XLB has not made a new high relative to TLT since late April of this year. What does that tell us? It tells us that the observable evidence is favoring hybrids or defensive growth ETFs over economically sensitive or weak dollar or reflation friendly ETFs. The model wants to see a chart like this improve before it starts to add things like energy, XLB, XME, etc. Those ETFs are performing very well year to date, but on a relative basis, XLB has been struggling significantly since posting this high, the ratio here, in late April of this year. The last thing it did was print a lower low. It hasn't made a higher high since April. That may change, but it hasn't changed yet. Also note, RSI looks very, very tepid here as price is struggling. So how does the model deal with this, and how does it help us going forward? As long as the S&P 500 remains in this long-term trading range in order to reduce whipsaws with the model, if we're in the range and the observable evidence clearly favors hybrids and defensive assets over growth-oriented assets, then in order to reduce trading frequency within the range and reduce the probability of whipsaws, and also to give us a chance to hold some assets, the model will continue to give the benefit of the doubt to defensive and hybrid ETFs until proven otherwise. The longer we stay in the range, the higher the hurdles become for us to consider moving back to pure growth ETFs. That may happen very, very soon, but the charts that we've just examined need to change. They may change, but the important part is they have not changed yet. Have all ETFs had trouble breaking out of long-term downtrends relative to TLT? Of course not, but the list right now relative to TLT is relatively short. Here's one example. If you know the commodity markets, you know that they peaked and have been in a long-term downtrend and they've been trying to base. You can draw trend lines really in any direction here from any high and any lower high, and we really can't bound price like we can on the XLB TLT chart. In order to move to the XLB, XLEs, and pure growth ETFs, we want to see those types of charts break out of those downward sloping trend channels. That may happen. It hasn't happened yet. Here's another example. This is the S&P 500 relative to treasuries. Something that's incredible if you were following the markets this week. The stock market basically went straight up for 4 days off of the Brexit low. Tuesday, Wednesday, Thursday, Friday, we went up. And yet, for the week, this is 1:28 p.m. on Friday, July 1st, the S&P 500 was still lagging TLT. That says a lot about the conviction of growth assets, the conviction to own growth relative to the conviction to own defensive-oriented treasuries. And much like the XLB TLT chart, this weekly chart is clearly in a downtrend. A high, a lower high, a lower high. This is a low, this is a lower low. The last thing this chart did was print a lower low relative to this low in February of this year. During this entire rally off of the February low, this ratio has been unable to even make a run at the previous highs. Like many charts, That may happen, but it hasn't happened yet. A good step would be for this ratio to clear this downward sloping trend line and to hold that breakout. If you're wondering what happened between 1:28 p.m. and 4 p.m. on Friday, July 1st, did this improve? No, it got worse. The S&P 500 lagged TLT in the post-Brexit week by 0.49%. Also notice the moving averages that we've been talking about in recent videos, rolling over, prices below all of the moving averages. This looks quite a bit different than this period here, or this period here, or this period here in 2015, when the ratio rallied for several weeks. This is the NASDAQ on Friday afternoon at 1:42 p.m. I could draw a downward sloping trend line here. The NASDAQ went back up into its Brexit gap and thus far has not made a higher high. It may happen, hasn't happened yet. As we noted on short takes earlier in the week in the George Soros post, European bank stocks and financial stocks have been hammered. Look at the retracement in that market relative to the Brexit decline. Major underperformance of European financial stocks, which speaks to a perception of risk in European financial stocks. Global stocks knocking on the door here before the Brexit results. We went straight down, we've come straight back up, but right now we have a high, a lower high, and another lower high. This is a lower low relative to this low, and this is a lower low relative to this low. All of that might change, but the last thing that happened on this chart was it printed a new lower low, a new multi-month lower low. These next three charts will really put these concepts into their proper perspective. It's somewhat of a wow look on the third chart. This is the inflection point that we've been looking at for several weeks. Zooming in, here's where we closed on Friday, July 1st. You can see stocks did incredibly well this week. The NYSE popped 3.26%, but you can also see that we don't really have any resolution yet. Stocks may break out, but this 3.26% rally goes into a different context when, notice, this is September of 2013 here, and this is the present day here. How does the chart look if we look at this index divided by defensive-oriented and deflation-friendly treasuries? Remember, we're going to look at it on the exact same time frame. Rather than making a run at breaking out, unbelievably this week, when the stock market went up over 3%, it was unable to outperform defensive treasuries. If you've been in the market a long time, when you get a huge relief rally like that, typically the stock market goes up 3% and something like a TLT is going to fall anywhere from 1 to 4% over that same period. Not the case here. TLT outperformed, and you can see this is a lower high relative to this high, this is a lower high relative to this high, so on and so forth. Lower low, lower low. The last thing this chart did, stocks, growth-oriented assets relative to defensive and deflation-friendly treasuries. The last thing it did was print a new weekly lower low. It has not even come close to exceeding the previous high in October, November of 2015. All of this may change, but as long as the evidence looks like this, and we're in the long-term trading range, the implementation rules will defer to the best option, which remains hybrid and defensive growth assets. It will also, based on the length of the trading range and how long we've been going through a whipsaw process, it will try to hold these assets and reduce trading frequency as we have already done. Now we're looking at NYSE daily, 1:31 p.m., Friday, July 1st, up 0.05%. Finished a little bit better, up 0.25%, so not materially different than what we're seeing here. Notice the first time we came up near the blue lines, look where RSI is, up here. Now we're back basically knocking on the same door. RSI was here near 70. Now it's closer to 50. Doesn't mean we're not going to break out, but this is somewhat of a tepid, kind of waning momentum look here, which doesn't predict anything. It just tells us that we should try to wait for price to prove it to us, which it so far has been unable to do. Here's silver weekly as of 1:53 p.m. on July 1st. All of these blue lines have acted as resistance for quite some time. This is July of 2014. You can see we have what appears to be a convincing breakout. Silver is falling over here. You can make an argument this is somewhat of a left shoulder here. Here's the head type look in this area, and this would be your right shoulder. If that's the case, we could see silver run for quite some time. Two things about silver. It's crazy in terms of volatility, so you have to be measured in terms of how much you add to a portfolio if you choose to buy silver. And you also have to understand that it's possible that this market and this ETF may want to come back and retest these blue lines, which it has not done yet. However, the longer term outlook right now for silver and for gold still looks favorable. Anything can happen over the next few trading days. Similar situation here, but they're a little bit ahead. Resistance, resistance, broke out, somewhat of a retest here, and this week came back and retested this area. Had a good week as of 1:56 p.m. That's a nice looking weekly candle. And this also broke out of somewhat of a long-term basing pattern after falling for a long, long time. Similar situation with REITs. This is late 2014, early 2015. Resistance, resistance, indecisiveness. It looks like we're trying to hold this here. It's an awful big move here. It might want to take a little bit of a breather too. It should also be noted that your hybrids, especially since they can make money in bull and bear markets, or at least have a chance to based on history. Therefore, that tells us that hybrids tend to have a lower correlation to the S&P 500, and there are periods where they can have a negative correlation, meaning the S&P 500 can zag and they can zig. In terms of risk assets in the S&P 500, what will probably determine what happens in this region here is how things shape up here. If we start to check some of these boxes here, it could get ugly for stocks. If this profile remains in play, it's possible with friendly central banks, stocks could break out to the upside. Even if that happens, that doesn't necessarily mean that stocks would be more attractive than some of these other options, which is relatively easy to see when we look at the chart of stocks relative to TLT weekly on July 1st, 2016. Some developments late in the week that may bring sentiment back this way. As noted on Twitter on Friday, Fed members talking about don't want to wait too long for the next interest rate hike. Markets obviously will be watching and listening relative to the Fed. And Friday, July 1st at 8:25 a.m. What this is, the leaders in terms of who may evolve in a leadership position in the UK, both of them, so the two leading candidates to take over, feel there's no rush to trigger Brexit. There's an Article 50 that has to be triggered by the UK. Germany and the rest of the EU has indicated that they want them to do that quickly. They're indicating that they're going to be in no rush. That could cause some tension, and we may check this Brexit gets messy box. Got a lot of moving parts here. The good news is we know that if we pay attention to the observable evidence, the chart, the risk-on, risk-off ratios, the ETF scoring system, the stack ranks, and the charts, and simple things like lower highs and lower lows, all of that information will eventually get us in the right place if we maintain that always important, flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.